Global oil prices have extended losses to around a 3-month low as traders weigh prospects of resuming supply through the Strait of Hormuz. The Brent now hovering around $80 per barrel, while WTI is closer to $77 per barrel. In Singapore, though, prices at the pump mostly held steady. Now, the average diesel price stands at $4.30 per litre. Only Shell cut prices by 10 cents. Average prices of 95-octane petrol still stands at around $3.45 per litre, unchanged since last Thursday. And for more analysis, we're now joined by Ole Hansen, who is the head of commodity strategy at Saxo. Ole, good to have you with us. Now, as we saw earlier, the Brent prices are having an immediate reaction after that US-Iran framework deal. Is this move mainly relief over the Strait of Hormuz, or were oil prices already vulnerable to a pullback?
Well, good evening, Angela, and greetings from Copenhagen. The market is right now responding to obviously the hope that we will get a full reopening later this week, and with that we could see a small tsunami of oil being released from tankers and ships already stuck in the Persian Gulf, ready to leave the Gulf, and that's why the short-term impact is one of lower prices, simply because we are going to see quite a significant amount of new barrels coming to the market. But it's also critical just to realize that that this is a fragile peace solution. We're still trading above pre-war levels, and I think we should probably not expect much lower prices at this point in time.
You mentioned the fragile peace solution, but it's still also very unclear how the US-Iran deal will work out. How do you expect this will impact oil prices in the short to medium term?
Well, as I said, in the short-term weakness, because we're going to see a lot of oil coming into the market. But then comes the hard work after that, because before the ships can return to the Gulf from Japan, from Singapore, wherever it's, or China, where it has offloaded its cargo, there will be quite a bit of a delay. And then only later on in 3 months' time, we will start to see production being close to fully restored. So it is a slow process, which the market potentially may just take a little bit too much at face value, that it's all going to be flowing from day one. So I think we have to be a little bit cautious. But in the short term, prices will soften. Especially we've seen obviously products, gasoline, diesel, jet fuel have all been in tight supply. These supplies will ease, and that hopefully should also lead to some lower prices at the pump in the near term.
So what would all of this mean then for energy importing economies like Singapore?
Well, it means, first of all, that we can hopefully put I would say, the inflation genie back in the bottle. That the worries that we had about inflation and its potential negative impact on growth can now be somewhat reduced. We got an FOMC meeting tomorrow, and it's going to be interesting to see what the kind of signal they sent, because the market has gone from expecting rate cuts to rate hikes in the US, and that obviously would have an impact on the wider global economy. So I think for now, for economies like Singapore, for Europe as well, it's a sigh of relief that we are hopefully past the worst in this crisis.
Now, fuel prices have fallen by a few cents in Singapore. How quickly do you think falling oil prices will translate at the pump here, if at all?
We will see lower prices as the product and product storage level starts to improve, as we start to receive shipments of increased shipments of diesel, gasoline, and jet fuel. At that point, we will also see refinery margins start to come down, and then at that point we could see lower prices. But it's a slow process, I would think, Angela. We could potentially see this staggered over the coming weeks, but there are hopes that we will see lower prices, not only because oil prices are lower, but also because refinery margins eventually will start to come down, because there's going to be more supply of the products that we need.
Ole, really appreciate your insights. That was Ole Hansen from Saxo Bank.